Imagine two people retiring at the exact same age. Jake is 62 years old, and after more than 30 years of investing, his 401k balance shows around $1.2 million. Marcus is also 62. He invested for the same amount of time, but his Roth IRA only shows around $885,000. At first glance, the answer seems obvious. Jake looks richer. Jake looks like the winner. He has more money on the screen, a bigger retirement account, and the kind of balance most people dream about. But here is the problem. The number you see in your retirement account is not always the number you actually get to keep. Because inside Jake's 401k, there is still someone waiting for their share. The government? Every dollar Jake withdraws later may be taxed as income. But Marcus's Roth IRA is different. His balance looks smaller, but most of that money can be withdrawn tax-free. So the real question is not who has the bigger account. The real question is, after taxes, withdrawal rules, Social Security, and decades of retirement, who actually keeps more money? And that is why so many people completely misunderstand the 401k versus Roth IRA debate. To keep this fair, let's put Jake and Marcus at the exact same starting point. Both of them are 30 years old. Both of them earn $75,000 a year. Both of them want to invest for more than 30 years, retire comfortably, and never worry about money again. The only difference is the account they choose. Jake chooses a 401k. Every year, he contributes 10% of his salary, which is $7,500. But Jake also has something Marcus does not have. His company offers a 4% employer match. That means Jake's company adds another $3,000 a year into his account. So even though Jake only puts in $7,500 of his own money, his 401k receives $10,500 every single year. And there is one more advantage. That money goes in before taxes. Jake does not pay tax on that contribution right now. So his paycheck does not feel the full hit. He is saving for retirement, lowering his taxable income, and getting free money from his employer at the same time. Marcus chooses a Roth IRA. He also contributes $7,500 a year. But Marcus gets no employer match, no free money from a company, no tax break today, and every dollar Marcus puts into his Roth IRA has already been taxed. So, in simple terms, Jake invests pre-tax money and gets extra money from his employer. Marcus invests after-tax money and has to build every dollar by himself. In the early years, Jake looks like the obvious winner. After the first year, Jake's account is already bigger. After 5 years, Jake has around $64,000 in his 401k. Marcus has around $46,000 in his Roth IRA. Jake looks at his balance and feels smart. His coworkers see his 401k growing faster and start asking him for investing advice. But Marcus, his account is smaller. He gets no match. He gets no tax deduction today. Nothing about his account looks exciting, at least not yet. Because in investing, the thing that looks best in the first 5 years is not always the thing that wins after 30 years. But here is the biggest problem with a 401k. Most people confuse tax deferral with tax freedom. A 401k does not make your taxes disappear. It only moves the tax bill into the future. Every dollar Jake puts into his 401k has not been taxed yet. Every dollar of growth inside that account has not been taxed yet either. And that feels amazing while he is working. His balance grows faster. His taxable income looks lower. His account statement gets bigger every year. But the tax bill is still there. It is just waiting. Because when Jake finally retires and starts withdrawing money, the government does not treat that money like some special retirement reward. It treats it like income. Not long-term capital gains, not a special lower retirement tax rate, ordinary income. The same way a paycheck is taxed. So if Jake withdraws $60,000 a year in retirement, the IRS does not simply say, "Congratulations, enjoy your savings." The IRS sees income. And after deductions, Jake may still owe more than $5,000 in federal taxes every single year. That means Jake does not really get to spend the full $60,000. Part of that money goes to the government before it ever reaches his life. But that is not even the whole problem. At a certain age, Jake may also face something called required minimum distributions, or RMDs. This means the government can force him to take money out of his 401k, even if he does not need it, even if he wants to leave the money invested, even if he wants to keep his taxable income low. If his 401k has grown very large, those required withdrawals can push his taxable income much higher than he expected. And when his taxable income rises, another problem can appear. A portion of his Social Security may also become taxable. This is the part many people never calculate. They look at a 401k balance and say, I have $1 million. But that is not the right question. The real question is, out of that $1 million, how much is actually mine? And how much is just money I am holding for the government? Because a large number on a retirement account statement does not mean you get to keep the whole thing. It only means the account is large. What matters is how much remains after taxes, forced withdrawals, and retirement income rules take their share. Now let's look at Marcus. Marcus's Roth IRA does not feel like a win in the early years. He does not get a tax deduction today. He does not get an employer match. His account grows slower than Jake's 401k. On paper, Marcus looks behind. But what Marcus is really doing is trading discomfort today for freedom in the future. Because every dollar Marcus puts into his Roth IRA has already been taxed before it enters the account. That feels painful now. His paycheck takes the hit today. He does not get the same immediate reward Jake gets. He does not get to lower his taxable income this year. But later, that decision becomes powerful. Because when Marcus retires and withdraws the money correctly, he can take it out tax-free. And that changes everything. If Jake withdraws $60,000 from his 401k, he has to think about taxes. The government sees that withdrawal as income. But if Marcus withdraws $60,000 from his Roth IRA, he may be able to keep the full $60,000. No federal tax on qualified withdrawals. No hidden tax bill waiting at the door. No feeling that part of his retirement money still belongs to someone else. Jake may have the bigger account balance, but every time Jake takes money out, part of it can disappear to taxes. Marcus may have the smaller account balance, but the number he sees is much closer to the number he can actually use. That is a massive difference. And Roth IRA has another advantage that many people completely miss: flexibility. If Marcus needs money before retirement, he may be able to withdraw his original Roth IRA contributions at any time, without taxes and without penalties. Not the investment gains, just the money he personally contributed. But that one detail can make a huge difference in real life. Imagine Jake and Marcus are both 50 years old. Life throws them the same emergency. Maybe a medical bill, maybe a family problem, maybe an unexpected expense. Both of them need $30,000. Jake goes to his 401k. Because he is not 59 and a half yet, he may face income tax plus a 10% early withdrawal penalty. So Jake takes out $30,000, but after taxes and penalties, he may only walk away with around $20,400. He needed $30,000, but he only gets about 2/3 of it. Marcus goes to his Roth IRA. He withdraws $30,000 from the contributions he already made. No tax, no penalty. He keeps the full $30,000. Same emergency, same amount of money needed, but Jake loses almost $10,000. Marcus keeps everything. And that is why the Roth IRA is not just a retirement account. It is also a layer of financial flexibility that many people do not notice. It may not look exciting in the beginning. It may not grow as fast on paper. It may not give you the instant tax reward of a 401k. But later, when taxes matter, when withdrawals matter, and when flexibility matters, the Roth IRA can become much more powerful than it looked in the first few years. But if I stopped here and said the Roth IRA always wins, that would be another mistake. Because the Roth IRA has real weaknesses too. And this is the part many people leave out when they talk about tax-free retirement money. The first weakness is the contribution limit. Marcus can only put $7,500 a year into his Roth IRA. Jake, on the other hand, can put much more into his 401k, and that is before we even talk about the employer match. So if someone wants to invest a large amount of money every year, the Roth IRA quickly becomes too small. It is powerful, but it does not give you a lot of space. The second weakness is that Marcus gets no free money from a company. Jake's employer match is $3,000 a year. At first, that may not sound life-changing, but when that money compounds for more than 30 years, it can become hundreds of thousands of dollars. That is why skipping an employer match is almost like leaving free money on the table. The Roth IRA gives Marcus tax-free growth, but it cannot replace a guaranteed employer match. The third weakness is that Marcus has to pay taxes first. Every year, Marcus contributes money that has already been taxed. Jake does not. Because Jake uses a traditional 401k, he gets a tax break today. In this example, Jake may save around $1,650 in taxes every year because of his 401k contribution. Marcus does not get that benefit, and that matters, because if Jake takes that tax savings and invests it separately, that money can also grow over time. So the Roth IRA is not free. Marcus is paying for future tax freedom by giving up a tax benefit today. And the fourth weakness is about future tax rates. The Roth IRA works best when your tax rate today is lower than your tax rate in the future. But what if that is not true? What if Marcus pays taxes today at a higher rate, but in retirement, his tax rate would have been lower? In that case, Marcus may have paid more tax up front than he needed to. That does not mean the Roth IRA is bad. It means the Roth IRA is not magic. It is a tool. And like every financial tool, it works best in the right situation. For younger workers, people in lower tax brackets, people who want flexibility, people who want more control in retirement, and people who believe future tax rates may be higher, the Roth IRA can be extremely powerful. But for high earners, people in a high tax bracket today, people who want to reduce taxes right now, or people with a strong employer match, the 401k can still be an incredibly strong account. That is why the real answer is not simple. Roth IRA is not always better. 401k is not always better. The account that wins depends on your income, your tax bracket, your employer match, your timeline, and what kind of flexibility you want in the future. And once you understand that, the debate changes. It is no longer about choosing the account that sounds better. It is about choosing the account that fits your real life. After more than 30 years, Jake retires with around $1,238,000 in his 401k. Marcus retires with around $885,000 in his Roth IRA. On paper, Jake wins by a lot. His account is bigger. His balance looks more impressive. If you only look at the number on the screen, it seems like the debate is over. Jake looks richer. But the moment they start withdrawing money, the story changes. Jake takes $60,000 a year from his 401k. But because that money was never taxed before, every withdrawal is treated as income. So Jake does not really get to spend the full $60,000. Part of it goes to taxes. Marcus also withdraws $60,000 a year from his Roth IRA. But because his money already went through the tax system before it entered the account, his qualified withdrawals can come out tax-free. Jake withdraws $60,000 and has to calculate what the government takes. Marcus withdraws $60,000 and may be able to keep the entire amount. That is where the retirement math starts to look very different. Over a 2-5-year retirement, Jake could pay around $127,000 in federal taxes just from his 401k withdrawals. And if those withdrawals cause more of his Social Security to become taxable, the total tax impact could rise to around $188,000. That is almost $200,000 leaving his retirement plan. Not because he invested badly, not because he failed to save, but because the account he chose delayed taxes instead of eliminating them. Marcus, on the other hand, may pay close to zero tax on qualified Roth IRA withdrawals, but this still does not mean the Roth IRA always wins. That is not the lesson. The real lesson is this: you cannot judge a retirement account only by the balance you see on the screen. A bigger number does not always mean more usable money. You have to ask better questions. After taxes, how much do I actually keep? How does this account affect my Social Security? Will I be forced to withdraw money later, even if I do not need it? If I need money early, will I face taxes and penalties? Is my tax rate today higher or lower than my tax rate might be in the future? And most importantly, am I leaving employer match money on the table? Because if your company matches your 401k contribution, that can be a 100% return on day one. No Roth IRA can replace that. Tax-free growth is powerful, but free employer money is also powerful. And that is why this decision is not about picking the account that sounds better. It is about understanding the full picture. The 401k can look better in the beginning because the balance grows faster. The Roth IRA can look better in retirement because the withdrawals can be cleaner. But the account that actually wins depends on the money you keep after taxes, rules, penalties, Social Security, and employer match are all included. Because the number on your retirement statement is only the starting point. The number that matters is the amount you actually get to use. So, what should you actually choose? 401k or Roth IRA? The practical answer is not choosing only one. For most working people, the better strategy is using them in the right order. Step 1. Contribute enough to your 401k to get the full employer match. If your company matches 4%, try to contribute at least 4%. Why? Because that match is free money. If you ignore it, you are not just missing an investment opportunity. You are refusing part of your own compensation. Think about it. If your employer is willing to put money into your retirement account just because you contribute, that is one of the easiest returns you will ever get. No stock picking, no market timing, no guessing where the economy goes next. Just contribute enough to get the match. That is the first move. Step 2. After you capture the full match, consider maxing out a Roth IRA if you are eligible. At that point, you have already taken the free money from your employer. Now you can start building an account that gives you something the traditional 401k does not give you. Tax-free qualified withdrawals in the future. More flexibility. No required minimum distributions during your lifetime. And more control over your taxable income in retirement. That is why the Roth IRA can be so valuable. It may not look exciting in the beginning. It may not grow as fast on paper. But later, when every retirement dollar matters, clean, tax-free money can become extremely powerful. Step 3. If you still have money left to invest, go back to your 401k and increase your contributions. Why? Because the 401k has a much higher contribution limit. It lets you shelter more income. It gives you more room to invest. And if you are in a higher tax bracket today, the current tax deduction can still be very valuable. This is how you combine the strengths of both accounts. The 401k gives you employer match, higher contribution limits, and a tax break today. The Roth IRA gives you tax-free money later, more flexibility, no RMDs during your lifetime, and more control in retirement. The mistake is not using a 401k. The mistake is not using a Roth IRA. The real mistake is listening to someone say, the 401k is always better, or the Roth IRA is always better, without running the numbers for your own life. Because personal finance is not about copying the loudest opinion. It is about matching the tool to your income, your tax bracket, your employer match, your timeline, your withdrawal needs, and your future tax risk. A simple answer may sound better, but the right answer is usually the one that includes everything. Taxes today, taxes tomorrow, employer match, contribution limits, withdrawal rules, early access, Social Security, and the amount of money you actually get to keep at the end. So the next time someone says they have $1 million in a 401k, do not only ask how big the account is, ask the more important question. After the government takes its share, how much of that money is actually yours? Because the balance on the screen is not the final number. The final number is what you can actually spend. And that is the number that matters.